Most investors think a Fed rate hike is a signal to sell, but history shows that for one specific group of stocks, it's actually a massive buy signal that the crowd completely ignores. The Federal Reserve controls an accelerator pedal that shapes everything from your mortgage rate to which sectors are about to soar or crash. When the Fed presses down, borrowing gets expensive and growth stocks look fragile. When they ease off, money becomes cheap and risk-taking returns. The problem is that surface level advice tells you high rates are always bad for stocks, and that's exactly the mistake that leaves money on the table. By the end of this video, you'll see exactly which sectors thrive when rates rise, which ones get crushed, and why one group that gets absolutely hated during a tightening cycle is positioned for the biggest snapback win once the Fed finally cuts. You'll understand how to read Fed announcements before the crowd reacts, which strategies to deploy before the next move happens, and how to position yourself to actually profit from the chaos instead of just surviving it. If you've ever wondered why Fed announcements trigger such massive stock frenzies or how professional investors stay ahead of the noise, you're in the right place. Let's start at the foundation by looking at what the Fed actually does and why its power over the markets is unmatched.
But first, this video is for informational purposes only and does not constitute financial, investment, or legal advice. Trading and Investing Hub is not a licensed financial advisor. Please do your own research and consult with a qualified professional before making any financial decisions.
The Federal Reserve is the central bank of the United States, and it was originally created to keep our economic and financial systems stable. Unlike Congress, the Fed does not have to chase votes because it was designed to be so that rate decisions stay away from the mess of politics. This independence matters more than you might think, because if investors felt the Fed was being manipulated, borrowing costs would spike since nobody would trust them to manage inflation. To keep things running, the Fed operates under what we call a dual mandate, which focuses on maximum employment and stable prices. Maximum employment doesn't mean zero unemployment. It just means the job market is strong enough that people are getting raises, but not so fast that it causes prices to spiral out of control. The other side of that coin is price stability, which the Fed defines as keeping inflation right around the 2% mark. When they can balance these two goals perfectly, they have the foundation for every rate decision they make throughout the year. The main tool in their kit is the federal funds rate, which is just the interest rate banks charge each other for overnight loans. You might wonder why a bank-to-bank rate matters to your personal bank account. But this master rate influences every other loan in existence. When the Fed raises this rate, your costs for mortgages and credit cards go up. But when they cut it, borrowing gets cheaper and people start spending more money. You can picture the entire American economy as a car driving down a long highway where the Fed is sitting in the driver's seat. If the car is moving too slowly and growth stalls out, the Fed taps the gas pedal by lowering interest rates to speed things up. On the other hand, if inflation gets too hot and the car starts speeding out of control, they tap the brakes by raising rates to cool things down. Here's where it gets interesting. Sometimes the Fed taps the brakes hard, and investors actually expect an economic crash, but the market rallies anyway. Why? Because the markets realize the Fed is being proactive and responsible, which builds confidence in the dollar's long-term value. This is exactly what happened in 1994. The Fed hiked rates aggressively, yet stocks and bonds both outperformed because investors saw stability returning. The lesson is simple. The Fed's action matters less than the reason behind it. Every Fed move ripples directly into your wallet. When rates go up, monthly payments jump. When they cut, asset prices often rise because future earnings look more valuable today. Now let's trace how a tiny rate change reaches your finances. When the Fed moves rates, they set off a chain reaction across the financial system. Think of it like tossing a rock in a pond. Some ripples hit your accounts instantly, while others take up to 18 months to reach the surface. The first ripple is what we call the saving and investment channel, and it changes how you handle your cash. When rates are low, your savings account basically pays nothing, which nudges people and businesses to stop hoarding cash and start borrowing to buy things or grow companies. On the flip side, higher rates make CDs and savings accounts look a lot more attractive. So money flows out of risky stocks and back into the bank, while high borrowing costs make people think twice about buying a new car or a bigger house. To put this in real terms, imagine you're financing a $400,000 mortgage at 3% with a monthly payment of roughly $1,700. If rates climb to 6%, that same loan jumps to about $2,400 a month, an extra $700 hitting your budget every single month. That's $8,400 a year that gets sucked out of your ability to spend on everything else. When millions of households face this squeeze simultaneously, consumer spending falls and the economy slows. Next up is the cash flow channel, which is where anyone carrying variable rate debt starts to feel the heat. If you have a credit card balance or a home equity line of credit, a Fed hike means your monthly payments are going up almost immediately. This extra cost squeezes your monthly budget and forces you to cut back on spending, whereas a Fed cut does the exact opposite by freeing up extra cash that usually flows right back into the economy. We also have to look at the asset price and wealth channel because interest rates act like gravity on the stock market and real estate. Lower rates make future profits look much more valuable today, which is exactly why growth stocks tend to go on massive runs whenever the Fed starts easing. A rate increase flips the math. Bonds start offering a real return, and those high-flying tech stocks or expensive rental properties suddenly lose their luster. Then there is the exchange rate channel, which determines how much your dollar is actually worth when you travel or buy imported goods. Higher rates in the US attract investors from all over the world who want to earn those better returns. And that extra demand for greenbacks makes the dollar much stronger. While a strong dollar makes your summer trip to Europe cheaper, it also makes American products more expensive for the rest of the world to buy. The most powerful ripple is expectations. Traders price an anticipated Fed moves weeks before they happen. If Wall Street expects a cut, stocks often rally in advance. If a hike is coming, bond yields jump long before the announcement. These channels work at different speeds, which is why every quarter point decision matters. Now, let's see which parts of the market win and lose. When the Fed tweaks rates, professionals immediately ask who wins and loses. Different sectors react differently, so let's break down the key behaviors. The biggest divide is usually between growth and value stocks, especially when you look at the tech sector. Growth companies are priced based on the massive profits they hope to make years down the road. But when rates go up, the value of those future dollars drops significantly. This is why speculative startups often get crushed during a hiking cycle, while value stocks, those boring established companies that pay steady dividends right now, tend to hold up much better. Financial stocks like banks have a very different relationship with interest rates because they make money on the spread between what they pay you for your deposits and what they charge for loans. This is known as the net interest margin, and it usually gets wider and more profitable when rates are moving up. The only real danger for banks is if rates climb so fast that people stop taking out loans entirely or start defaulting on their debt. But in a steady hiking phase, financials usually shine. When it comes to bonds, the rule is very simple. When yields go up, bond prices go down. This hit is felt most by long-term bonds because they are locked into lower payments for a longer period of time. On the other hand, when the Fed starts cutting rates, bonds usually rally because those older, higher-paying coupons suddenly look like a great deal. If you think we are entering an easing cycle, extending your bond duration can be a very profitable move. Real estate and REITs are also incredibly sensitive because the entire industry runs on debt and mortgages. Higher rates kill affordability for buyers and drive up the cost of doing business for real estate investment trusts, which usually leads to a slump in the sector. However, this group tends to snap back incredibly fast when rates fall because cheaper mortgages bring buyers back into the market and refinancing costs drop through the floor. You should also keep an eye on utilities, which many investors treat as a bond proxy because of their high dividends. A 4% dividend from a power company looks amazing when a treasury bond only pays 1%. But if you can get 5% from a risk-free government bond, that utility stock loses its appeal. Because these companies carry massive amounts of debt to build infrastructure, rising rates hit them with a double whammy of higher costs and lower investor demand. The tech sector is actually a bit more nuanced than people think because giants like Apple and Microsoft are sitting on mountains of cash. These mega-cap firms can actually benefit from rate hikes because their cash reserves earn more interest, and their global dominance keeps demand high regardless of the Fed. Here's the cash mountain strategy in action. Apple holds roughly $160 billion in cash. When the Fed raises rates to 5%, that pile earns roughly $8 billion annually in risk-free interest income, money that flows straight to shareholders and offsets any pressure from higher borrowing costs or a slower economy. It's a hidden hedge that most investors completely miss. Meanwhile, it's the smaller speculative tech companies that rely on cheap debt to survive that become extremely vulnerable the moment capital gets expensive. Their survival depends on venture capital funding or cheap loans, and when those dry up, their stock price collapses. This is why mega-cap tech can hold up in a rising rate environment while the rest of the sector gets decimated. Finally, we have the battle between cyclicals and defensives. Cyclical sectors like energy, industrials, and consumer discretionary usually outperform when the Fed is cutting rates because those cuts stimulate the spending that drives their profits. Defensive sectors like healthcare and consumer staples might lag during a big bull market, but they are great places to hide when the Fed is tightening because people still need medicine and groceries no matter what the economy is doing. Rate cycles cause constant sector rotation. Spotting these rotations early lets you move your money before the crowd catches on. Now let's break down the actual strategy for each environment. A tightening cycle makes bond risk priority 1. Rising yields hit long-term bond prices hardest. Protect yourself by shortening duration, favor short-term bonds, or build a bond ladder. Here's the 3-step bond ladder playbook. Step 1. Divide your bond allocation into 5 equal chunks. Step 2. Buy bonds that mature in 1, 2, 3, 4, and 5 years respectively. Step 3. As each bond matures annually, reinvest that principal into a new 5-year bond at the current higher rate. You've now created a system that automatically locks in rising yields without the guesswork of timing. Also consider floating rate securities, whose payouts adjust upward as rates climb. In this environment, cash becomes a surprisingly powerful tool for your portfolio. High-yield savings accounts and short-term CDs start paying out attractive, nearly risk-free returns that most people overlook. Using these accounts helps you sidestep the decline in bond prices while keeping your dry powder ready for better opportunities down the road. When it comes to stocks, favor resilience over pure growth. Value stocks with strong cash flows and low debt outperform speculative, unprofitable companies. Overweight financials to capture the margin expansion we covered earlier. Avoid profitless tech startups. Their valuations melt away when funding costs soar. Prioritize quality. Easing cycles flip your playbook. Bonds benefit immediately. Higher coupon bonds become more valuable as new yields fall. Extend duration now. Longer-term bonds see the biggest price jumps. Lock in higher CD rates early before cuts deepen. For stocks, easing cycles favor growth and cyclicals. As the discount rate drops, tech, consumer discretionary, and industrials lead the rally. Small caps benefit most. Cheaper financing fuels expansion. Real estate and REITs swing from headwind to tailwind during easing. Cheaper mortgages bring buyers back, pushing prices up. REIT borrowing costs drop, improving their bottom line. Utilities also look better as falling yields make their dividends competitive. This is often the most overlooked opportunity. Real estate doesn't just recover slowly, it often rebounds hardest once cuts arrive. Investors miss this because they remember the rate hike pain, but historically, that snapback is incredibly powerful. You don't need to time the Fed perfectly, just tilt the right direction. During hiking, raise cash and keep bond durations short. When easing arrives, extend duration and move into growth or cyclicals. Real estate swings can turn an average portfolio into a top performer if you're positioned when cuts arrive. Use the Fed cycle like a compass to guide your money. History's patterns are worth learning. In 1994, the Fed doubled rates from 3% to 6% in just over a year. Most expected an economic crash, but inflation cooled while growth stayed strong. A soft landing. Rate hikes don't automatically destroy markets. Context matters more than the raw number. Easing cycles see tech and consumer stocks rally as borrowing gets cheaper. Tightening cycles rotate toward defensive sectors like healthcare and staples. Match your investments to the cycle phase. To read what the Fed is doing in real time, you have to look past the big headlines. Subtle changes in the wording of the Federal Open Market Committee statement can tell you everything. If they shift from saying they will monitor the data to saying they remain attentive, they are reframing what they expect to do with rates in the future. You also need to watch the dot plot. Think of it as the Fed's secret map. This chart, released in the Summary of Economic Projections, shows exactly where every policymaker thinks rates will be in the future. And the market often cares more about these dots than the actual rate decision. Here's how to spot a hawkish pivot before the crowd catches on. Look at whether the dots are moving upward, fewer cuts ahead, or downward, more cuts coming. If the middle dot for next year moved higher than it was at the last meeting, that's your signal. It means the Fed is getting tougher and they're planning to keep rates higher for longer. Markets will punish this hard. Stocks typically sell off and bond yields spike, but you'll see it coming 3 months before it becomes obvious. If those dots are clustered higher than people expected, stocks might actually fall even if the Fed just cut rates because it signals that fewer cuts are coming later. This is the specific edge that professional traders use every quarter. The chair's press conference matters as much as the data. Phrases like policy is sufficiently restrictive spark rallies or sell-offs. Compare current language to the previous meeting. Don't ignore global effects. Fed tightening strengthens the dollar, pressuring emerging markets and weakening commodities. When the Fed cuts, this reverses. Look at the full cycle context and position yourself before the crowd catches on. When the Fed moves rates, they reshape everything. Valuations, currency strength, and global cash flows. But here's what separates you from the crowd. Most investors panic when rates rise and sell the one sector that's actually positioned for a massive snapback win. They miss it because they fixate on the pain phase and forget that real estate doesn't just recover slowly, it rebounds hardest. You now have the playbook. You know the channels, you know which sectors thrive and which ones get crushed. But knowledge without action is just noise. So take what we covered here and actually position yourself before the next move happens. Real estate swings hardest when rates shift. And because most investors are still panicking while watching the headlines, that's exactly when you position early and move your money into the sectors about to bounce. Have the guts to act when others are still fearful, and you turn a boring chart into a real win for your bank account. While the rest of the market is staring at the Fed's rate decision in confusion, you're looking at the cycle as a roadmap. Once you stop reacting to the news and start anticipating the moves, the Fed stops being a wild card and starts acting like a tool you actually control. If this helped, hit the like button and subscribe for more trading and investing resources. And drop a comment below to suggest a topic to break down next.
The illest ciphers open, no joking. Trading and Investing Hub. Yeah, that's the spot. We teach you how to get the capital and make the profits bubble up. Trading and Investing Hub.